Welcome to Debt Matters. Today we are focusing on recent reporting regarding Lloyds, Halifax, and MBNA credit card rate increases.
Yeah, and it's one of those things that usually flies right under the radar.
Exactly. Our goal for this episode is to unpack what these upcoming changes really mean for you, the UK borrower. We want to look at how a routine pricing update can quietly increase household debt pressure.
Right, because it just arrives in the mail disguised as standard administrative paperwork.
It really does. And we're going to walk you through the practical options available if your borrowing costs suddenly go up, because when you get that letter, you actually have choices.
Choices you probably don't realize exist.
Right. So I am really curious about how this actually hits everyday budgets.
Well, understanding that requires looking at the mechanics of how credit card pricing operates behind the scenes. Lenders evaluate profitability, and that directly affects the numbers you see on your statement.
Let's talk about those numbers. The coverage indicates that affected customers are seeing standard purchase and cash rates rise by roughly 4.25 to 4.5 percentage points.
Yeah, that is a big jump.
And I want to be very precise here. This is an addition of 4.5 percentage points. So if your current rate is, say, 19%?
It jumps up to 23.5%.
Exactly.
Which alters the daily calculation of your borrowing costs quite a bit. And the timeline here is crucial.
Right. The changes are scheduled to start in May 2026.
Yes. Having that buffer gives you a short window to actually review your finances and do something about it.
Before the new rates just get slapped onto your balances.
Exactly. But we should clarify who is actually affected here. This is not an across-the-board hike for everyone.
So transactors, people who clear their balances to zero every month, they aren't hit by this.
Generally, no.
Yeah.
The banks are repricing the risk exclusively on carrying balances.
Okay, so it's specifically for revolvers.
Right. If you repay your full balance every month, the standard grace period shields you from purchase interest anyway.
Yeah.
The impact of this 4.5-point hike lands squarely on you if you carry revolving debt from month to month.
Let's bring those percentages to life with a specific example from the reporting. Depending on the exact rate change applied to your account, the extra cost could be about £45 a year for every £1,000 of debt held.
Let's scale that up to a very common household scenario.
Okay.
Say you are holding a balance of £4,000 on an MBNA or Lloyds card. That translates to an extra £180 a year simply to hold the exact same amount of debt.
It's funny how a letter saying, "We are going to charge you more money for the exact same service," always looks like a boring administrative update.
They definitely design it that way.
If my local pub mailed me a notice saying my pint now costs an extra 4.5%, I wouldn't just unquestioningly pay it. But here you're paying £180 more just to stand completely still.
And it makes the path to repayment so much longer. When your rate increases, a larger portion of your monthly payment is diverted to cover the interest charge.
Instead of paying down the principal.
Right. If you pay a fixed amount every month, say you have a direct debit set to £150, this rate hike guarantees your debt will stick around longer, adding even more months of interest.
So I was looking through the consumer regulations, and they outline a hidden consumer right that I think most people are completely unaware of.
The opt-out.
Yeah. We usually view letters from our bank as absolute decrees. You get the notice, you grumble, you toss it in the recycling bin, and you accept your fate.
But you don't have to.
Guidance highlights that customers typically have a 60-day window to reject the rate increase.
It is a fundamental pillar of consumer rights here. When a lender changes your terms, they are legally obligated to give you notice, and they must give you the option to say no.
So I can just call them and say no?
You can formally reject the change and continue paying off your existing balance at your old, cheaper rate.
That sounds amazing, but there is a structural trade-off we need to explain.
Yes, there's a catch. If you reject the hike, your account will be closed for any future transactions.
Meaning I can't use the card to buy anything ever again.
Exactly. Your available credit line vanishes. The card simply becomes a closed repayment vehicle.
That creates a massive real-world dilemma.
It really does. You have to look at your own safety net. If you reject this hike, do you have an emergency fund to fall back on if the boiler breaks?
Or if you need new tires to get to work.
Right. Voluntarily freezing a credit line is a big decision for households that rely on it to cover essential monthly costs.
On one hand, accepting the rate means a more expensive balance. On the other, rejecting it freezes the card, which brilliantly stops the debt from growing, but it removes that safety net.
Which is why the banks bank on, well, they model consumer apathy into these rollouts.
Behavioral inertia.
Exactly. They know a large percentage of customers will just glance at the letter, assume as legal jargon, and throw it away.
The friction of making a phone call, waiting on hold, and actively deciding to freeze a credit line is just too high for the average person.
The bank calculates that even with the 60-day opt-out rule, the vast majority of people will just absorb the 4.5-point hike by default.
And they price that apathy into their revenue projections.
They absolutely do. And if we connect the dots to the larger UK economic picture, this highlights why credit card pricing is such a complex landscape.
We hear about the Bank of England base rate on the news and assume our borrowing costs track that national benchmark.
Which isn't the case at all.
Right. People see the base rate holding steady and they assume their credit card rates will naturally do the same.
But credit card pricing does not always neatly track the base rate. Lenders adjust rates based on internal risk, profitability targets, and account behavior.
So even if the national picture is stable, a retail bank might decide they need to fundamentally reprice their own risk portfolio.
Exactly. They look at their ledger and decide the cost of borrowing for certain products has to go up.
And this brings us to how household debt pressure actually builds in the real world. We often think of financial trouble as a sudden, dramatic event.
Like a job loss.
Yeah. But it often builds incredibly quietly. Higher borrowing costs lead to more missed payments and accounts drifting into arrears.
It builds through fractional squeezes on the monthly budget. When the interest rate goes up, your minimum payment might go up, leaving you with less disposable income.
And if the minimum payment stays the same, almost none of it is actually attacking the principal balance.
Right. Lenders legally set minimum payment thresholds just a tiny fraction above the monthly interest charge.
It's designed to keep you on the hook.
That is the danger of sticky debt. When people are only making minimum payments, balances hang around longer.
Which makes early intervention so vital.
Definitely. Once you start struggling with a higher rate, there's a huge risk of juggling payments.
Using one form of credit to cover another.
Which we know is heavily monitored in debt management. It's unsustainable.
You start using a Halifax card to pay the minimum on a personal loan. It's a house of cards.
Which is why paying attention to notices and acting early is crucial. The timeline stretching to May 2026 is your opportunity.
Rejecting the rate is one tool, but freezing the card is the nuclear option. What other levers can someone pull?
Paying down the balance faster is the most immediate step. Every pound you clear before May is a pound that avoids the extra 4.5 percentage points.
And if you can't pay it off, transferring to a lower-cost product seems incredibly useful.
Checking your eligibility for a 0% or low-interest balance transfer card should be an immediate next step. You move the debt off the Lloyds or MBNA card.
Put it on a new card with a promotional rate for 12 or 18 months.
And use that window to aggressively pay down the principal without the high interest charges.
Just don't leave the old card open and start racking up new debt on it.
That is a very common trap. You have to be proactive.
So the final takeaway here is that debt stress in 2026 remains a live issue.
Very much so.
And financial pressure doesn't always start with a dramatic default notice. Sometimes it begins with a quiet pricing change in the mail.
If you are carrying a balance, pay close attention to any rate change notice and understand your options.
Which leads me to ask you directly, if your lender raised your credit card rate tomorrow, would you know whether to accept it, reject it, transfer the balance, or challenge it?
Having a plan removes the panic.
I'll leave you with a final thought to mull over. If rejecting a rate hike forces you to close your card to new spending, could a bank's decision to raise your rates actually be the unexpected catalyst you need to break the cycle of revolving debt once and for all?
That is a powerful reframe.
Thank you for listening to Debt Matters. Keep a close eye on your mail and take control of your borrowing. We will catch you next time.